Good morning and happy Sunday from Chicago. I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, November 17th, 2024. Today I'll be talking about what Asbury Research's latest data-driven market research and quantitative models are saying about current financial market conditions as we head into the end of the year. In today's podcast, I'm going to show you some of the key charts, market metrics, and the latest signals in our own quantitative models that we believe are the most important in determining where the U.S. stock market goes from here. What makes Asbury Research different from other research and asset management firms is that we are completely data-driven. We are data analysts rather than forecasters of the future. We focus on what is rather than what might be. As such, we do very little predicting or forecasting because at best, it's always just an educated guess on what might happen next week or next month or next year. There's too many variables that could change a forecast in very short order. And most important, the market could care less of what we think as analysts, traders, or as investors. Our focus is on reading the latest data as indicated by our models and on understanding which data series to be focusing on right now. What's the market looking at to determine what the market thinks, because the market's opinion is the only one that matters. And when the market changes its mind, we can see that in our data. We can see that in our own models, and we change right along with it rather than getting married to a certain prediction or a certain forecast that we made a week ago or a month ago, which is always a bad idea. The market's a dynamic thing, and we use data and models to stay on top of what it's thinking today. Asbury Research is a registered investment advisor that has been providing both investment research and asset management to individual and professional investors since 2005. So this is our 20th year. To get more information about us, visit asburyresearch.com and click the Contact tab, which is right here. We're looking at the Contact tab right here. Or you can just click the link in the description of this video down below. Finally, if these YouTube videos are useful to you, please like and subscribe. Let's begin with just a couple of fast announcements. Number one, I will appear on the Schwab Network's Morning Trade Live show on Tuesday, November the 19th. That's this upcoming Tuesday at approximately 9:10 in the morning Chicago time, 10:10 if you live in New York. I'll be on with lead anchor Oliver Rennick to discuss what we see, what Asbury Research sees as the latest and best opportunities in the market as we head into year end. You can tune in live via schwabnetwork.com, or I will have the video available usually within a day or so. If you go to About, which I'm doing now, and scroll down to videos, that's where all our videos that we do for various media outlets, that's where they reside. There's a lot of videos in there, so if you like videos, that's where you go. Number two, we have recently launched the Substack newsletter. There's a free version that you can sign up for right now by visiting asburyresearch.substack.com. There's also a very affordable pay version that Follow the Money viewers can request a free 30-day trial of by visiting asburyresearch.com again and going to the Contact tab. All you need to do is click the Contact tab, and in the little text box type FTM Substack free trial, and we will get you started on that 30-day free trial of our paid version of our Substack. Finally, we have recently combined our own models to create 4 model portfolios. These models are available through our premium research service, or we can now trade the portfolios for you within your investment portfolio, or if you're a money manager, within your client's portfolios. You could learn more about them here by going to Asset Management and scrolling down. Each one of these has a prospectus that indicates more details, how they've done our back tests, what their ingredients are. So if you're interested in trading a portfolio, this is how you find out a little bit more information about the portfolios we're currently offering. Now let's follow the money. and get down to business as we identify our key areas of focus as we look towards the end of the year. First thing we're going to do is we're going to go to the research center here. This is the password paywall part of this. This is the other side of the paywall. This is our premium subscriber service right here in the research center. And what we're going to do is we're going to look at the Asbury 6. You can see as we scroll down, all of our models are right up on top of the research center. The CPM, the correction protection model, our CEF model, our sector rotation model is here. For now, we're going to look at the Asbury 6 and see where we are in terms of market internals through Friday. So the Asbury 6 shifted to a positive status on November the 6th. We're still holding that positive status because we would need to go to 4 or more red constituent metrics in order to turn the model itself, turn it to a negative reading. So we're still positive, but we're 3 and 3. 3 and 3 is really important to me because it indicates the market's in balance. If you look at the Asbury 6 as a scale, when 4 or more are green, if all 6 are green, that scale is fully weighted to one side with the market pointing upward. If it's all red, which we'll have if we're in a really weak market, it's tilted over to the other side. Right now, the scale is balanced. We've got 3 green and 3 positive. Again, we're still holding on to the November 6th positive reading in the A6 itself. It would take 4 or more red to turn it to red. But the reason this is important is because of where the market is right now. We're going to get to that in just a second. The Asbury 6 is our daily updated risk management model that looks beyond the day-to-day volatility and noise in the stock market. What we're starting to see more and more often where we get up in the morning and the market opens 50 lower and it's 50 higher by lunchtime. This is to keep us focused on what's important, the internals of the market, and not all of the computerized trading gyrations, which most of it is noise, or certainly a whole lot of it is noise. So we don't get bumped out of a good idea because of intraday market volatility. The next thing we're going to do is we're going to go to keys to this week, which is one of the standard reports that we do. This was actually done on Friday. So this chart is very recent. It's very current. This shows where the key levels to watch are in the S&P 500 because it's the benchmark. That's why we always track the S&P 500. It's kind of a broad overview. So you can see that we are testing what I would call initial tactical support here at 58.78. The market closed right on top of it. What does that represent? Well, the October 17th previous minor high and also the gap that we made after it became clear that Trump was going to win the election and the S&P opened when it opened 130 higher that day. So that 58.78 area is the first support level that we have to deal with. What makes it extra significant is because of the 3 and 3 status of the Asbury 6. It is in balance right now. So that tells me to attach that balanced signal, if you will, by the A6 with this underlying support level at 58.68. That tells me that the market has a tactical decision to make early next week. If this uptrend is still healthy, tactically, we should hold the 58.78 area and we should see the Asbury 6 rock back to 4 or more green early in the week. If that doesn't happen, and the Asbury 6 switches to 4 or more red constituents, that tells me this 58.78 is very likely to be broken, and the next level underneath there is about 2% lower at 57.72. That's the 50-day moving average. That's a minor trend proxy that a lot of people look at to determine what the minor trend of the market is. So really important to see what happens there. At 57.72, assuming the worst, and we're going to break down next week, and we go to 57.72, that's a more important pivotal level for me as far as support. If that is broken, That indicates that we are going into some kind of a corrective phase, which we'll also see in the Asbury 6, and we should also see in the CPM. And that would clear the decks for another about 2% move down lower to the next support level at 56.70 to 56.52. That's the July and August highs from earlier this year. Next thing we want to look at also in our Keys to This Week report as we scroll down. This is a little bit, I wouldn't say longer term, but it's not so fast twitchy as the A6. This is standard deviation that we're looking at now. This is a percentage of NYSE stocks trading 2 standard deviations above the 40-day moving average. So what we can see here going back to 2023, that whenever we get 34% or higher reading in this particular metric and turn back the other way, these have all been important peaks in the S&P 500 with one exception, and I'll get to that in a second. But you could see July of 2023, several month peak in the S&P. You can see at the end of March of this year, that was another minor peak in a very, very strong year. Another minor peak here in July, in the middle part of July. And we've got another one now. We peaked on November the 11th, and the indicator is turning down. The only exception was back here in late December of 2023. The reason for that is in the second week of January of this year, there was an important symposium held in Las Vegas where a lot of big AI companies, including NVIDIA and others that were huge market cap, they unveiled some new AI technologies that they were going to have for their businesses, and the market saw that and just ran straight up. That was a huge catalyst in the first quarter of this year. But generally, what this is telling us is the market is a mean reversion animal, and it's starting to revert back to the mean, and this is a place where we can look for that mean reversion. We don't act on this. We want to use our Asbury 6 for a trigger, our CPM model for a trigger, and if we break that support level that I showed you. But this does tell you that there are some implications that what's happening right now could turn out to be some kind of a correction. The next thing we're going to do is we're going to go back to the Research Center, and we're going to look at some ETF trading ideas that we've been talking about here in Follow the Money. So we're going to scroll down to our ETF trade ideas. And when I was with you last, which was the 3rd of November, it was 2 Sundays ago, we said that we had been long GLD, the gold ETF. We actually bought that at on 8/19. We exited that trade on 11/6. Let's take a look at it on a price chart. So here's gold, and we bought gold here according to our ETF trade ideas. We bought gold here. This is gold relative to the S&P 500, because ideally we not only want to make money on the outright trade, but we want to outperform the S&P. So we bought here, and we were stopped out right here as gold gapped lower. This was the day that the S&P 500 had that 130-point gap higher on the open, gold gap lower, and we got out. So we still made a nice profit on here, and we made a little bit, we outperformed the S&P by just a little bit. So that's the gold trade. The next one we're going to look at, I don't know if I mentioned this the last time I was with you, but we bought IGV, which is the iShares Expanded Tech Software Sector ETF, on 10/25. And we exited that trade on 11/14. You can see it right here, for a 13% outright gain, 10% relative outperformance versus the S&P 500. Let's have a look at that one real quick. So that's IGV. Punching that in. So we bought IGV here on that date of 10/25. And we exited right on the opening here. We had our stop cranked up really tight because we made a lot of money in just a few weeks. We were up 13-14% in 3 weeks. So we don't let those get away. We make sure that we get paid on our good ideas. So we made 13% here, and we outperformed the S&P 500 by 10%, again, in just a few weeks. So the only trade that we have on right now is we are still in XTL, which is the Spider Telecom ETF. We're looking to add more ideas next week, depending on how this goes with support and with the Asbury 6. Premium subscribers will get an emailed Asbury alert as we publish them to the Research Center. Finally, let's have a look and see how our models are doing year to date and since their inception. So we're going to change views on you one more time. And this is something that we update once a week at the end of the week, just so we can watch our own models, see how we're doing. So our CPM model, a correction protection model, is I look at it as a dynamic stock bond portfolio. Normally, your investment advisor, or commonly, let's say, your investment advisor has a meeting with you and you tell them how old you are and how risk averse you are and when you want to retire and how much money you want to leave to your heirs, all these cookie cutter questions that they ask you. And then they'll say, well, Bill, you're a 65-35 stock and bond mix guy. And they'll set you up, set your portfolio up like that, set it and forget it, and then you get an electronic birthday card on your birthday. I don't like the set it and forget it. I think the market should be telling us whether we should be in stocks or bonds, and not a questionnaire that we ask all of our clients. So that's what CPM is for. It protects us against the correction, thus the name. Let's look at this year. It's trailing the S&P by a little bit over 3%. CPM's up 21.6. SPY is up 24.7. But the maximum drawdown is significantly less in CPM, only a drawdown of 5.8% instead of 8.5%. Standard deviation is lower for CPM. Our beta is lower for CPM. This is what I care about. We invest in these models. They're not day trades. They are going to keep us in, they're going to watch our downside and capitalize on our opportunities on a longer term basis and not a week by week type of thing. So this is what I'm interested in. Since inception, you can see the annualized total return of CPM is right on top of S&P 500, almost identically the same, but the maximum drawdown in the CPM is only 20% instead of 34%, which I'm pointing to right here for SPY. Our beta is much lower. It's almost, it's 40% lower, and our standard deviation is almost 5% lower. So this means that we are giving this has produced the S&P looking backward because nobody can see forward. It's mimicking the S&P 500 with about 40% less risk. The next thing I want to look at here is our SEAF model, our sector rotation model, which we didn't look at this week because we had other things to show you. But year to date, we're trailing the S&P 500 by 2.4%, but with a lower maximum drawdown, significantly lower maximum drawdown, lower beta, and a lower standard deviation. Here's the long-term performance of this looking back to summer of 2018, the end of June of 2018, more specifically. It has outperformed the S&P on an annualized basis by 8.24%, with a 4.5% lower maximum drawdown, slightly lower standard deviation, and a slightly lower beta. This is why we trade these models. The other thing I wanted to point out about the SEAF model is how we're doing against our peers. The SEAF model is a sector rotation model. So we picked out 4 different ETFs that do some form of sector rotation. Here we are versus them year to date. You can see so far, year to date, SEAF has been the best performer, 22.32%. The next closest one is 20.8%. Then if we look at historical going back to June of 2018, we can see SEAF annualized 21.28%. The next closest is, let's look across here, is 12.66% by SECT, S-E-C-T. They have over $1 billion under management. And so it's nice to this is something we do once a week. We want to see not only how we're doing versus the S&P, but how we're doing versus our peers. So we had a lot to cover this week, and let's get back to our landing page and finish up here. So that's going to wrap it up for this week, Following the Money podcast. Our next Following the Money podcast is tentatively scheduled 2 weeks from today, Sunday, December the 1st. If you like our approach to investing, we can help you with either data-driven research or money management that implements my 40-plus years of experience in the financial markets and a lot of quantitative backtesting to produce our own data-driven models and model portfolios. You can request more information about us by going to asburyresearch.com right here and clicking the Contact tab. I am off to watch my beloved Chicago Bears take on the reviled Green Bay Packers. And so I will see you in 2 weeks. Please don't forget to like and subscribe. Have a fantastic Sunday.